Hello.
Hey, how you doing?
Good, good. Setting the stuff up still.
So with the slide situation, let me see, because I want to make sure that we are moving according to where you are. I'm gonna make you a co-host, and I feel like you should be able to control my screen on here. Okay, so I just gave you remote control access to my screen. So in the event that you need to,
Whoa, that's crazy. Look at you, fancy hotshot.
I learned this from Mike.
Okay, okay, okay. I see. Okay, and then I can do the. All right, I can skip the slides. You're right. Nice. That's really cool. Thank you.
Oh yeah, awesome. Because I was like, I didn't know if I was keeping up where you were on your slides, and I didn't want that to be an issue today. All right, so I'm gonna assume that we'll get the majority of participants at 3 o'clock and not at 12. So we can
Oh,
record this one and run it at 3.
okay. Well, are we trying to do this again same time next month?
Yeah, we can. I'm not opposed to it.
Yeah, and then we can have it set a little bit earlier out. Like I said, we can post it up on Eventbrite, do a Facebook event as well.
Heck yeah. That also definitely played a role in turnout for sure. But I know they did send it home. I don't think so with the school, if I'm being honest, I think they get majority of the turnout through the kids, not through um Parent Square or the normal means of communication.
That's fair.
Um, I'll have to go into the school and post flyers and stuff for next month.
Okay. I mean, I'd be happy to come out with you for the day and just knock out.
Okay, yeah, heck yeah, that'll be great. Meet I like the principal. Principal's pretty cool. She's pretty flexible, understanding. She's great with the kids. She love the kids.
It's good.
She
I
love the
feel like it's easier to love them when they're not high schoolers.
Oh yeah, they're easier to love than not yours. You know, I know that sounds terrible, but that is the reality.
It's so wild you're a mom. Like what?
Yeah, yeah. It be your own kids. I'm telling you, your kids will definitely throw you
You
off.
ain't even a one mom, you're a two mom.
Yeah, yeah, that is me.
No, you look great. So
Thank you, thank you. Let my kids leave it to my kids. They're gonna ask, why your belly fat? You got a baby in your belly?
yeah,
What?
my mom would have been, why is your mouth swollen?
Yeah, yeah, that is right because you are the reason why my damn stomach look like this. Don't don't show my face.
Be like, I'll show you exactly why.
Yeah, yeah. You know, kids are Kids are hilarious. Broke best friends for sure.
That's
100%.
funny. I got plenty of those still.
Yep, yep. Broke best friends. My daughter put her pants on today, and I'm like, oh, look, girl, our pants look the same. We twinning. She's like, ooh.
I'm gonna be right back. I'm gonna grab a tissue before this starts.
No worries. Children of the Corn. What do you got going on? Daddy's being mean to me. Daddy's being mean to you? Or are you just not listening? He's not. Daddy's not listening. Daddy's not listening? Are you listening? Are you really? I bet. I believe it. Can you put my brain down? Okay. All right. Children, I told you mommy is in a meeting, and as soon as I'm done, I'll come down there and hang out with you guys, okay? Love you. Can you not scream? Exactly. Can you go find daddy? Mm-hmm. Daddy's in the play. Can you go find him? Daddy's in the play. Okay, can you go find him? Can you tell him to come here, please? Aubrey, can you go tell daddy to come here, please? Little terrorist. That's what. Is he coming? Yeah. Can you keep them out of here, please? Hey, put Stitch down. One, two. Okay, going out.
Let's go.
If you listen, I'll get you on.
Go. Go. Let's go.
All right.
Do you want to wait 5 more minutes or go ahead and get started?
We'll start at 12:05.
Okay, sounds good.
In my office. Oh. Mhm. There's a way. Mhm. Right, we go ahead and get started here. Thank you everyone for attending our basic income tax webinar with our special guest here, Connor Downey, real estate consultant. Yeah, let's go ahead and get started. Just a basic informational income tax webinar with some good old advice, strategies, and information from Mr. Connor here.
Thank you very much for having me. I'm super excited to discuss real estate with all of you today. Stay tuned, I'll be coming at the end.
Awesome. And Connor, thank you for attending as well. Can't wait to share this information with everyone here. Just a brief overview, welcome introduction, then we'll move over to key tax concepts, essential tax documents, the differences between tax deductions and credits, some tax strategies, and then we are going to give Mr. Connor his time here. That's how that meeting or this webinar is going to go. A little bit about me. My name is Aliyah Dixon. I am a business and tax strategist. I have been in the tax industry for a little over 7 years now. Serial entrepreneur myself. I love helping other entrepreneurs as best as I can, whether it's from operations to business analytics. I do have degrees in both of those things here. But my passion really just comes from helping others understand how to run a successful business, what things you should have in place, how to document those things that you have in place. And then on the tax side, I truly enjoy the educational aspect of educating people about taxes and how to lower their tax liabilities in a tax compliant way, a legal way. Offices of Aliyah Dixon is a tax and financial advisory here. Outside of me, who is a business and tax strategist, clients also receive access to a credit consultant who specializes in repairing, building, and leveraging their credit, real estate consultant who provides insight on real estate as a means to build wealth. And then we have a financial advisor who helps create these game plans, and he also specializes in retirement strategies. All four of us work together to help get you to financial freedom, whatever that looks like for you, wherever you want to be. We can help you calculate a game plan and hold your hand if need be. So that's kind of what we do here at Offices of Aliyah Dixon with me and my partners do. Each one of us stand as a financial building block, and we come together to help build a financial empire. What we do together, we build comprehensive financial solutions, starting with tax and business strategies, credit optimization, real estate guidance, and financial planning. We're first going to dive into income tax brackets. One of the misconceptions or misunderstandings about the income tax brackets is not understanding that it's a progressive tax. So the more income that you make, the more that you're taxed on. And this is kind of what it looks like. So we're going to take the single and married filing separate filing status here. And we have buckets. Each bucket is held at a different tax rate. So anything or any income up to $11,925 for the tax year 2025, you're going to be taxed on 10%. Anything from $11,926 to $48,475, you'll be taxed at 12%. And then going forward, as you increase your income, if it's between these thresholds, you'll be taxed on this rate. Okay, so it just continues. The more income that you make, the more income is taxed. But again, you got to think of it as brackets. If your income falls under this particular bracket, so on the 12%, this between 11,926 and 48,475 will be taxed at 12%. Right? So here's a chart. Again, single, married, filing separate. If your taxable income is not over or it's under $11,925, 10%, you'll be taxed at 10% on that income. Anything over $11,925, but not under $48,000, you'll have this base percent of this base tax of 10% here, plus 12% of anything over $11,925, but not over, but under $48,475. So again, it's tax brackets. So think of each bracket here as a bucket. $11,925 will be taxed at 10%. Anything between $11,926 and $48,475 will be taxed at 10% plus 12%. Essentially, that's how that works. So if you are in the 22% tax bracket, that means you make about $50,000, but 48,475 of that is going to be taxed at different rates. So you'll have 10%, 12%, and the 2,000 that's left over between 48,000 and 50,000, which is 2,000, will be taxed at 22%. So here's another chart, and it has the higher tax brackets here. So 32, 35, 37 is 7 tax brackets all together. And the more income you make, the more, the further along the line you go. The taxable income amounts do change based on filing status. So head of household is a little greater at 17,000. So if you make about 17,000, not over 17,000, you'll be taxed at 10%. The married filing joint has a higher taxable income. So if you are at 23,000, it's 10% of that. So the thresholds increase between single, head of household, and married filing joint. Okay, married filing joint 9 times out of 10 is going to always be more favorable. I'm not going to say go ahead and get married or anything like that, but from a tax standpoint, you definitely do get some good old deductions and credits and all that. Is definitely more favorable, married filing joint. Okay, standard deduction versus itemized deduction. What is a standard deduction? Standard deduction is a figure that everyone receives no matter what your filing status is. The amount changes based on your filing status, but everyone receives a standard deduction, and the standard deduction is there to lower your income. So what does that look like? Head of household, the standard deduction is $21,900. If you made $50,000 and you are head of household, instead of being taxed at 50,000, you're only taxed on, let me pull my calculator out so I'm not incorrect here. 50,000, subtract the standard deduction, you're only taxed on $28,100 versus 50,000. So that's what the standard deduction does. It helps bring your income down so you're not taxed on the entire amount. Head of household, $21,900. Married filing joint, $29,200. And then you have single and married filing joint, or married filing separate, I'm sorry, $14,600. Again, here you can see that it is more favorable to file married filing joint. The IRS, or the income taxes for married filing joint, again, are going to be more favorable, okay? You have a higher standard deduction, which means you're going to be taxed on less. Single and married filing separate are not favorable in the eyes of the IRS. What they promote, married filing joint, and having kids. So you see, head of household, we're at $21,900, still higher than single and married filing separate. So having kids and being married is definitely more favorable in the eyes of the IRS. Additional amounts are provided if you are blind or over the age of 65. I believe it's $1,400 on top of the regular standard deduction. Okay, so it's an additional standard deduction that you're given you're blind or over the age of 65. Itemized deductions are your state and local income taxes, real estate and property taxes, mortgage interest, disaster losses, gifts to charities, and medical and dental expenses combined. So gifts to charities include nonprofit donations. So say you donate to Goodwill, you donate to Girl Scouts, you donate to the Salvation Army. All of those things can be added to your tax return. If you donate to church or if you tithe, that goes on your itemized deductions. And given they are greater than the standard deduction. So if your state and local income taxes, your real estate taxes, personal property taxes, mortgage interest, your disaster losses, your gifts, and your medical dental expenses are greater than the standard deduction, 9 times out of 10, you will want to take the itemized deductions. Okay. If you can itemize, go for it because it helps bring your taxable income down even further. So let's say you have mortgage interest of $12,000, real estate taxes of another $3,000, you're at $15,000. Say you had medical procedures that cost another $10,000. Right there alone, you're at $25,000. If you're head of household, so you have dependents, you will want to take the itemized deductions because you can bring your income down $25,000 versus $21,900. Okay. So there are certain situations where itemized deductions are beneficial, but again, you have to have your receipts and your documentation for all of the things that you claim on your tax return. Do not claim medical expenses that you have not paid for. Just because you got the bill does not mean you can claim it. You have to pay for that bill in order to be able to claim it on your tax return. Okay, I want to make that clear because I have clients who are like, yeah, I have a medical bill of $10,000. And the next question I ask is, did you pay the $10,000 or did you just get the bill? Oh, I just got the bill. Okay, well, unfortunately, you can't claim that. You didn't pay it. So, yeah, make sure you pay, okay, in order for you to claim the deduction. Make sure you keep your receipt as well. How to choose between standard and itemized. Again, if your itemized deductions are greater than your standard deduction, then you want to take itemized deductions, okay? So yeah, that's pretty much the basics on standard versus itemized deductions. Now we'll go over your tax documents. What tax documents should you bring to your tax appointment, upload before your tax appointment, or provide to your tax professional? The most common documents are going to be W-2s, 1099 NEC, 1099-K forms, 1099 miscellaneous forms, 1099 interest forms, 1099 dividend forms, 1098 mortgage statements, 1098-T tuition statements, Form 1095 A, B, or C, which are healthcare statements. Then you have your state and local tax refund statements and 1099 SSA Social Security benefits form. 1099 NEC and 1099-K, and often 1099 miscellaneous forms are received if you are self-employed to some degree. 1099 non-employee compensation forms, NEC forms, are typically for contractors and subcontractors. So those are going to be your self-employed employees. I'm sorry, not employees, but your self-employed taxpayers. Form 1099-K are also 9 times out of 10 for your self-employed people out there as well. If you use a card processing company, they are going to issue out a 1099-K. So what is a card processing company? So companies such as Stripe or PayPal are going to issue out a 1099-K for the following or the year before the tax year. So that's where you'll get 1099-Ks from, card processing companies. 1099 miscellaneous forms are often received for those who are landlords and they use a property management company. Property management company is going to issue out a 1099 miscellaneous with the amount of rent received for your property. So that is your income statement for landlords. 1099 interest statements are going to be issued most of the time if you have a savings account that grows with interest or you get interest. Savings account, there are some bank like checking accounts that issue out 1099 interest forms as well, but majority of the time they're going to come from a savings account. 1099 dividends, if you receive dividends, whether that be a bank account or your stocks and trading accounts, you're going to receive a 1099 dividend, okay? Form 1098 mortgage statement shows your mortgage interest and it shows your real estate taxes as well. 1098 tuition statements are going to show scholarships, and it's going to show the amounts paid for tuition. So if you are in college, enrolled in college, you'll receive a tuition statement. Form 1095A comes from the healthcare marketplace. If you have healthcare marketplace insurance, or what is also known as Obamacare, you'll receive a 1095A. 1095A forms are entered into the tax return. Okay. 1095B and C forms are informational. You should still supply those to your tax professional, but they're more so informational. They're not directly entered into the tax return like a 1095A is. You have your state and local tax refunds. If you receive a tax refund from the state and then you turn around and itemize, you're going to have to add that number into your itemized deductions. Okay. So if you do receive a 1099-G, you'll want to add that to your tax documents that you send over to your tax professional. Do keep in mind, a lot of states have opted into electronic delivery. I know Georgia specifically has opted into delivering your 1099-Gs electronically. So you'll want to be on the lookout through your mail and through your Georgia Tax Center account for that 1099-G. 1099 SSA forms are for those who receive Social Security benefits throughout the year. You have Social Security benefits throughout the year. Social Security Administration is going to issue out a 1099 with the amount that you have received. Okay, so we broke it down a little further here. If you are a parent, tax documents you'll want to bring are going to be child care tuition statements and a Form 1098-T if you have a student who is in college and you plan on claiming them as a dependent. You'll want to provide both of those statements there. Keep in mind with child care, however, you can only claim child care and the child dependent care tax credit if you send your children off to child care to work. Okay, you have to work while they are in school or while they are at daycare in order for you to claim that credit. For teachers, you are able to deduct what you have spent on your classroom, which is called the educator expense. It's up to $300 that you can get back on your tax return if you have paid more than $300, or if you have paid only $150, you can claim that and get that back on your return, but it's capped out at $300. So if you paid to decorate your classroom, if you paid to provide supplies for your classroom, then you are able to get up to $300 back on your tax return. For students who have attended college, you'll want to be on the lookout for a 1098-T, which is the tuition statement. You'll want to look out for a 1098-E student loan interest. If you are paying back your student loans, any interest that you pay, you can deduct on your tax return, and it will be on a Form 1098-E. If you have paid out of pocket for supplies, books, the little scantrons that you take quizzes and exams on, if you pay for any of those things, you can deduct that as well. You want to have a document or a spreadsheet and your receipts as well, but the document will have the totals for the year on them, and then you'll have the receipts just to back up and substantiate everything. If you're self-employed, what you want to provide to your tax professional is going to be your 1099 forms. That is either going to be a 1099 NEC, 1099-K, or if you're a rental landlord or a lawyer, you'll have a 1099 miscellaneous form. You'll also want to provide a profit and loss statement, which summarizes your income and your expenses. This is going to make it so much easier for your tax professional, right? And IRS now are requiring things such as profit and loss statements for tax professionals to have on file. So just to substantiate and provide clarification and verification on your tax return. So if you are a business, you should definitely have some sort of accounting software, whether it be QuickBooks or a simple Excel spreadsheet. But you want to make sure that you are keeping up with your expenses and you are able to provide a profit and loss statement at the end of the year. Okay.
Hey, Aliyah, I'm not seeing your screen right now.
Oh, okay. So let's see here. I share screen.
Lumi's still seeing the screen, so
Okay. Perfect. Okay, so while
perfect. Okay, I just wanted to let you know.
okay, now I appreciate that. You should be able to see it. One participant, multiple. Do you have all of the participants open on your screen, Connor?
I do. I do have them all open right here.
Okay. Let's see here. This is interesting. So you're not going to be able to see it. Let me pause it. Stop it. And share it again.
Yeah, I can see it again now. Thank you very much.
Awesome. No problem.
Sorry about that, guys.
Okay, are you still able to see it, Connor? Perfect. Okay, I gave you remote access again, okay?
Thank you very much.
Awesome. So receipts. Your receipts are not mandatory for you to upload to your tax professional. What they are mandatory for, though, is to substantiate and verify everything on your profit and loss statement. What I advise clients to do are to digitize your receipts, and you can do that by taking a picture, uploading it to the cloud somewhere, whether it be Dropbox, whether it be Microsoft OneDrive, or Google Drive. Upload it to a drive somewhere and keep it because receipts fade. And once the receipts fade, you no longer have documentation for that expense. So you want to make sure you digitize your receipts, make sure you keep it on file, just in case in the event that you do get audited, the IRS are going to want bank statements and they are going to want actual receipts for everything. A mileage log for business vehicle deductions. So a mileage log should include the origination, where you started, your final destination, where you ended, the number of miles for that trip, and the purpose for that trip, and who you met for that trip, right? Essentially, that is the who, what, why, and when, and where. The 5 W's, as it was taught to us in school. You'll want to make sure that you have that. And I do want to double back on receipts. For receipts, you are going to want to add your 5 whys. Make sure you have that information. If you're sitting with the client over a dinner, you're going to want to write on the back of it who you sat with and why. And that substantiates that is a ordinary and necessary expense for your business. Home office expenses, you'll also want to include, if you're going to take the home office deduction, you'll want to include things like rent, utilities, internet, and insurance. And for your home office deduction, you can add that on an Excel spreadsheet as well. You'll also want to include square footage of your office space and your entire home. Okay, so that way your tax professional can calculate the home office percentage, and then they can then calculate the home office deduction. If you've made any quarterly estimated taxes or self-employment tax payments, you'll also want to let your tax preparer know as well. You can upload the receipt for those and say, hey, I made my quarterly estimated taxes. Make sure it's on my return, please, and thank you. In the event that you've made health insurance payments or premium payments, you'll want to include those as well. You can get a deduction for having insurance and being self-employed. And then if you've made any retirement contributions to a 401k or an IRA, you'll also want to include those so that way you can get your deduction for that as well. Tax credits. Okay, so you have tax credits and you have tax deductions. They do different things, but here we're going to discuss a tax credit. And a tax credit is a dollar for dollar amount that taxpayers can claim on their tax return to help reduce the tax that they owe. Okay, it brings their tax bill down. Tax credits are broken down into refundable or non-refundable. Refundable credits are going to be dollar for dollar. That's what they get back as a refund. Okay, it boosts your refund. Refundable credits boost your refund. Non-refundable credits lower your tax liability. Okay, so it's different. One you get back in a form as a refund, and the other, which are non-refundable, just brings your tax bill down. Refundable credit, such as the Earned Income Tax Credit. Earned Income Tax Credit is for moderate and low income taxpayers. So if you are under a certain income threshold, you may qualify for the Earned Income Credit. Okay. There is an age requirement. You have to be at least 25 in order to qualify for the Earned Income Credit. If you have children, it helps, but you don't have to have children. If you do not have any children or dependents, then it's just strictly based off of age and income. You have Education American Opportunity Credit, which is also a refundable credit, which means you can get a portion of it back as a form of a refund. In order to qualify, you have to be pursuing a degree or be enrolled at least half-time. Okay, so at least part-time student pursuing a degree at a credible college institution, and you have to be within your first 4 years of college. After your 4th year, creeping into that 5th year, you're no longer eligible to claim the American Opportunity Credit, but then you can claim the Lifetime Learning Credit, which we'll go over a little bit later. So the American Opportunity Credit is mostly for those in their undergrad program, first getting into college. After that 5th year, you switch credits. You also cannot have a felony drug conviction in order to qualify for the American Opportunity Credit, and you must receive a 1098-T form, and again, attend an eligible institution. Okay. Your tax professional should know whether or not your education credit will qualify, and they will be able to tell you whether or not it's an institution that qualifies. Non-refundable credits. So again, these just lower your tax bill, okay? You have your lifetime learning credit. And lifetime learning credit, again, to qualify, you have to have a 1098-T. You have to be at an eligible institution. And there is not an age requirement or anything for this one, but this one is mostly for your graduate students. So if you are pursuing your master's degree, you'll no longer qualify for the American Opportunity Tax Credit, but you'll then qualify for a lifetime learning credit. Another non-refundable credit is the child tax credit, which again reduces the taxpayer's tax liability. And to qualify, the child that your dependent must be under the age of 17, have a social security number before filing, and can be claimed as a dependent. Okay. The dependent care credit, again, is non-refundable and helps reduce your tax liability. In order to get a dependent care credit, which is if you're sending your children to daycare and you're paying for daycare in order to qualify for that credit, the child has to be under the age 13 or disabled, not able to care for themselves, and you must send them to daycare so that you can work. Okay. If you're going out on the weekends to go be in them streets and you pay for daycare or childcare, you can't write that off because you're just going out there to have fun and be in the streets. But if you're working, then you can definitely consider that dependent care and get that credit for it. Couple of tax strategies here. And tax strategies are meant to lower your taxable income, not to evade. I think there is a misconception that you can get out of paying taxes. You can't. What you can do is lower the amount of taxes that you pay and then defer those taxes or pay taxes later. You have to pay taxes, guys, everybody, but you can plan accordingly to lower your taxable income and lower the amount of taxes that you pay. And how do you do that? Well, the first one, honestly, is to pay the correct amount of taxes. You don't want to have a large refund when you go filing, and you don't want to have a large balance due. You typically want to zero out when you go to file your tax return. You want to have no balance and you want to have no refund. Now, if you have children, dependents, and you are receiving credits, especially earned income credit, then you're going to have a large refund, but the goal is to zero out. Okay. You can also contribute to retirement plans, so 401ks, IRAs, max those out. That will help lower your taxable income. You can contribute to medical accounts such as HSAs or FSAs. That'll help lower your taxable income. So for HSA and FSA medical accounts, you're deferring tax later. So you're taking some of your income, putting it into one of these qualified accounts, and for any medical expenses that you incur, you can take it from there. So that way you get a deduction upfront for even contributing to one. So that upfront is lowering your taxable income. And then you can turn around and pull from that money that you set aside for copays, for medical things. There's all sorts of things that you can pay for at HSA and at FSA. Doesn't necessarily have to be prescriptions and copays. It can be your lady products. It can be um, um, I'm sorry, I'm drawing a blank here. Uh, um, ooh, not diapers, but if you are having yeah, I'm drawing a blank here. I can't think of the word. Adult diapers. There we go. You can pay for adult diapers with your HSA and FSA accounts. So instead of paying that with your after-tax dollars that you need, so you can set up an HSA account and pull it from there and still get a tax deduction at the end of the year. So just kind of shifting your income here and creating some deductions. If you are self-employed, what you can do is prepay your business expenses. So come December, you realize you have $10,000 in profits and you don't want to get taxed on $10,000, and you're like, what can I do? What can I do? Go ahead and pay some of your expenses for the year following. So if you have a cell phone, a business cell phone, or a website, or an email marketing platform that you're paying for, you can go ahead and pay for it in advance. So that way it lowers your income that you're taxed on. And then you won't have to worry about paying those expenses later. If you're self-employed, you can also consider hiring family. That is what I do. Okay, I have my youngest. She helps me with cleaning my office, and I pay her bi-weekly, and I get a tax deduction. And I'm paying my daughter, so she can pay for her own things. Oh, you want extracurricular activities? Well, you just got paid, darling. You can pay for it. You want some new shoes? You got the money for it. So hiring your children, hiring your family could definitely be something that you can use as a tax strategy. I use it. It's a pretty good tax strategy. How to choose your tax professional. I would like to say you got to ask questions, right? What questions do you ask? Well, assess their credentials, look for qualifications, look for experience, inquire whether or not they work with people in your specific situation. Say you are a taxpayer, you typically have a balance due, but you own your own business. Are you able to help me? This is my situation. I don't want to owe $12,000 at the end of the year anymore. What can I do? Are you someone who specializes in this area? Check for industry expertise. Tax laws are constantly changing, and quite often they change in the current tax law, especially when we are switching out presidents, such as this time now. There are a few tax laws that change. What is your tax professional doing to stay up to date on those tax laws? Are they studying? Are they keeping up to date? Do they even check the IRS website? Now, I've come across, I like to network, right? I like to talk to other people. I like to see what they're doing, what they've done, what works for them, all, the normal networking stuff. Upon asking those questions, I've come to realize that a lot of people do not take continuing education credits. They do not utilize platforms that provide continuing education credits. Sometimes they don't even know that we are able to take continuing education credits. You can also check the IRS website. They have a database of all IRS credentialed tax preparers. So the IRS, they do have a program that tax professionals can take, uh, and it refreshes their memory, keeps them up to date on the tax laws and things like that. If they take that course, then they are going to be added to the IRS tax professional database. So you're just asking, what do you do to stay up to date? Do you take any courses? Is a really good question that you can ask your tax professional. Ask about the services they offer. Are they open year round? Do they offer additional services, or do they just prepare your tax return and you don't hear from them for a year? If that's the case, you may want to consider your tax professional reconsider, because a tax professional is definitely a part of your financial empire. They are a building block. They should, there are people who are just there January through April, but you want to look for someone who is open year round and can provide year round support. For example, hey, tax professional, can you look at my pay stub and make sure I'm withholding enough throughout the year? That is a very simple service that they should be able to provide to you to make sure that you are not going to owe the following year. You should be able to contact your tax professional with any tax questions and they answer it regardless of the time of the year. Ask questions about their fees. You can request pricing up front. What are your fees to file X, Y, and Z? They should be able to answer that. If they start basing their fee on your refund, then you may want to throw up a red flag, because by law, we're not allowed to do that. But again, if your tax professional isn't keeping up with the IRS law, they're not going to know that. I've run into tax professionals who price based off a refund, not knowing that legally they're not allowed to. So ask questions. Please ask questions. Also verify reputation and look at reviews. You can ask for referrals. You can look them up on Google. Yeah, ask for testimonies and stuff like that. And then ponder about their communication style. Do they listen? Do they educate? How fast do they respond? Those are all good questions to ask and things to look for. All right, Connor, you are up and it is your go.
If it'll let me talk real quick. So
There you go.
thank you guys for coming. I'm super happy to be here. Obviously, I'm going to start by letting you guys know just a bit about myself. So we'll get over to this next slide if you don't mind. So in general, I have been selling real estate for 4 years now. Simply put, I work under a broker, and every single broker hires agents. Up until you get qualified for 2 years, you cannot pursue being a broker, and that is how the structure of real estate works. I have been selling real estate since I graduated from Georgia State University with my bachelor's in interdisciplinary studies, which is a fancy way of saying I know a lot of stuff very broadly, topics including law, society, ethics, statistics, I mean, you name it, political science, social sciences. I've been around the gambit, and it really helps me understand how much homeownership affects our economy, affects lifestyle, and affects wealth building. So today we're going to attach just how wealth building comes from your tax benefits of homeownership. We want to start here with, I think I actually skipped a slide. Let me go back. Yes, this is the first slide. Home ownership builds wealth through equity. And we're going to teach you guys how exactly you maintain that equity and avoid paying taxes, or at least reduce the cost, because Aliyah says you always have to pay taxes. We don't want to misinterpret that sometime you're going to pay Uncle Sam. So with home ownership, we build equity. Equity is simply the value of a mortgaged property after deductions or charges against it. That essentially means you can go down to the bank, get a loan, and that is the mortgage amount on the property. Now, whatever you guys have that is valued over the property, such as paying off your principal balance or improving the home, say adding a pool, refreshing your exterior paint, adding a luxury kitchen to the home, these are all going to provide you with equity. It's going to be the difference between the value and the debt on the home. Does this all make sense to you, Aliyah? Okay, great. So data shows that annually, homes appreciate in equity naturally without you doing anything, 3 to 5% a year. This is obviously based on the community, the surrounding schools, if they just built a Costco in the area. So it can be on a higher end, it can be on a lower end. Say that you bought a home and right next door they built a landfill. Obviously, the appreciation may be on the lower end. However, these are statistic number stats based on the last 20 years. So this is from 2000 up until 2020, and this provides that 3 to 5% equity is increased year over year simply by owning real estate. Now, what does that do for you? It creates different styles of investing. And I like homeowners to realize that just because you're buying a home to protect your family and know that you always have a safe place, it doesn't mean that you shouldn't think about it as an investment. That's where you start to go wrong. Your first home is never going to be perfect unless you truly were patient and you got every last dime out of your income and you put it towards your housing. Let's be realistic. Some of the best investment strategies start with house hacking, which is a roommate style living to offset the cost of your mortgage. People do this with their families in multi-generational fashions. Sometimes people are moving in with their aunts, their uncles, and it's allowing them to afford bigger homes, reduce the cost of their mortgage on themselves, and build equity. So you have roommates who are now offsetting your debts, which are now paying down every month on your equity on your home, and you are building wealth for your family in the future. This is a great way to get in very simply without having a complex thought. You can buy a home, ask a family member, ask a close friend to live with you, and this is going to tremendously increase your ability to build wealth versus renting an apartment, renting a home, renting a townhouse, where every single month, everything that you pay is the same debt plus some. And I'm going to give you an example. If I am an investor and I purchase a home, and that home costs me $2,000 a month in mortgage, my goal is essentially to charge my tenant $2,200 a month. I do not want to have any liability for my taxes, for my repairs, for any of those things. And tenants typically forget that their peace of mind is always being paid for by themselves. So whenever you're looking for something and you want an ease of access and you think renting is the better option, don't forget you are paying for someone else's equity, you are paying for your own peace of mind, and essentially you could be locking that wealth down for yourself. As we get through this consult, I'm obviously going to tell you guys how to purchase a home, what programs are available to you, and then at a later date, if you want to pursue that, we can discuss documentations that you need, required credit scores, and all of those kind of things. But again, today we're going to focus on why it's such a great idea to get into investing in real estate and how it benefits you with taxes. So if you are not wanting to do a house hacking strategy, you are too old, you have 3 children, a husband, a dog, 6 cats, and you need privacy, you may want to consider a buy and hold real estate style. Again, even if you're purchasing a home as a first-time home buyer, you need to think about it in a perspective of an investment. Are you buying this home to make profit? Yes, we are always buying this home to make profit and build wealth. So when we buy this home, we know that we are holding this home because every year that we hold this home, it's going to appreciate typically 3 to 5% per year. That means if we've held this home compounding interest for the last 5 to 7 years, we should have some sort of wealth and equity built. Now, we could break it down, do some calculations, but let's keep it simple. You've built equity no matter what, no improvements to your home because you've bought it and you've held it over a long period of time. This is a great strategy for passive investors, first-time home buyers, and multi-generational families, very similar to the house hacking style. Now, the reason we talk about house hacking and buy and hold strategies first is because they are the most simple ways for you to increase your equity, which is increasing your wealth. Every single time you're making these mortgage payments, you're increasing your wealth. This can eventually lead into a great opportunity for you to access this equity. This equity that you've been paying into your home is actually a tax deductible resource that can be accessed with a very great tax benefit, and we'll cover that very soon. So say you guys have the opportunity to have built this equity. you will go down to the bank and you will do something called a cash out refinance. This will allow you to pull out your wealth in a large sum and go into a fix and flip opportunity. This is great for building rapid capital wealth, and this is going to be a totally new investment strategy versus the buy and hold and the house hacking. So we're going to give you an example. Say you purchase a home at $100,000 because you've pulled all of the equity out of your home. This is the wealth that you've saved up for your family over the last 5 to 7 years. And you said, we're comfortable staying in our home, but we want to increase our wealth. Let's try a fix and flip property. You purchase it at $100,000. You take your other income, maybe use your credit cards, do what you have to do, and you repair the house with up to, let's say, $20,000 in repairs. This home is now worth $150,000. You turn around and you sell it to Miss Aliyah Dixon, and she's super grateful, and you made $30,000. Of this money, you've just rapidly increased your generational wealth, your ability to have flexibility, cash flow, whatever it is that you want to think about. Our issue now is we have so much money. How do we reduce our tax liability? That is exactly what we're here to talk about. You just made $30,000 profit. The thing is, you pulled $100,000 out before. I'm sure you're wondering, is that profit as well? Cool thing is, with a refinance, you are taking out a debt on a previous amount of equity that you owe, and you are getting this tax-free because it is a debt. If you guys remember what Ms. Aliyah said, if you are paying interest on a debt, it can actually be used as a tax deduction. This is the exact same example on a larger scale. It's really impressive. Very high-end investors are doing this every single day to make million-dollar portfolios seem like nothing. I mean, I've seen bank accounts with tens of $1,000,000, and it's just wild. And these people don't even think anything about it because they are constantly moving this money, never actually having to pay the taxes up front and putting it into more wealth building opportunities. And that first fix and flip eventually leads you to your next investment strategy. It's called BRRRR. It's a very simple strategy: buy, renovate, refinance, repeat. That's exactly what I told you to do for your fix and flip. You would have bought a home. You would have either stayed in it or renovated. You would have refinanced to pull out your equity. That's tax-free once you refinance it. And then you repeat the process by buying another property to do such. This is almost an infinite compounding opportunity for your money if you speak with your tax professional correctly. It's very wild. They don't want you to break the rules. They don't want you to be sticking money in a box under your couch. They want you to talk with Aliyah. They want you to make money and generate wealth and keep it and secure it to go on to build apartment complexes and generate more money, to open hospitals and create jobs. It's not a conspiracy theory against us to get wealthy. People think paying taxes is a negative thing. People think getting into real estate is what makes you wealthy. No, it's an opportunity to secure your wealth through decreased taxation. So we're going to get into, obviously, short-term rentals and long-term rentals very simultaneously. This is kind of something that you may consider further down the line if you have already had a BRRRR strategy or you need to further decrease your tax liabilities. If you have a short-term rental or a long-term rental, you can still secure equity. You can have tenants paying down the equity in your house, so you're continuously generating a profit. Now think about it like this. You may only make $200 a month in cash hand in your pocket from your tenant, and that's what you pay taxes on. However, that $2,000 a month that your tenant pays towards your mortgage, you pay no taxes on. That is constantly reducing a debt. That's not your capital gains. It's not your profit. Until you access that equity, it cannot be taxed. So we carry on. The short-term rentals and the long-term rentals are an opportunity for you to continuously have cash flow while securing an equitable asset that's being paid for by someone else. Simply put, you can own a lot of wealth and put all of the burden on someone else. It may not be what you think is ideal, but it's the way that you do it that makes it ethical. Keep it simple. We're going to go on to the next slide here. I know that was probably a lot of information. I know I talked a lot about investment strategies, but for me, I do this for the homeowners, the first-time guys, the people who want to start building this. And there are a lot of simple tax benefits for homeowners in general. Georgia offers a homestead exemption. This only applies to your primary residence. And I I honestly get this a lot where people say you're a homesteader. For you to have a homestead, it has to be X amount of acres or you have to have farm animals. No, that's incorrect. That's a false belief. It's actually something that has people being taxed poorly on their primary residence for years. I mean, costing them thousands of dollars. This Georgia homestead exemption allows you as a primary resident actually decrease your tax liability that you pay on your property taxes throughout the year. And if you know anything about housing and Uncle Sam, as the economy gets better, the housing cost goes up, the local areas continue to increase. And it's wild because your monthly mortgage payment never changes, but your taxes can always increase. So, that being said, you may have a fixed interest rate, you may have a fixed principal, and all of a sudden your $2,000 a month mortgage has increased rapidly overnight, it seems. 2022, it might have been only $100 in property taxes. Now, 2025, it's $300 in property taxes a month. That is exceptionally huge. And this is something that can be avoided with the application of your homestead exemption. So, individuals get homestead exemption. It allows you to have up to $2,000 deduction from your total assessed value of your home, but it also works as a protection. Individuals are protected up to $21,500 of their equity against debtors in their home. So, God forbid you fall off of a roof and you broke your back, and now you have $21,000 in medical bills. You haven't been able to pay, and these guys are calling you every single day. They want to put a lien against your house. They want to take your home from your family because you haven't been working. You are protected up to $21,500 of that money. It is not very much. There are other states with other regulations, like Florida, which has a Fort Knox law, and debtors cannot come after your properties whatsoever. But this is a great benefit, especially if you're married. It increases up to 43,000 of your dollars in equity that can't be touched. So I'll give you an example. We'll use a $100,000 house. You have paid off $43,000 on that house over the last 5 years. The debtor comes to you and they said, "We want your $43,000. You're like, "I don't have a dime in my bank account." They said, "We're coming for your house." And you're like, "You can't. I legally am protected for all the equity that I've paid." Now, if you paid $43,001, the debtors can come for that $1. Does that make sense? Okay. So, continuing on the exemption, this stops you from being forced to sell your home to pay your debts. This stops you from being forced to borrow against your home's equity to pay your debts, unless, of course, it's past that $43,000 if you're married, or past that $21,500 if you're a single individual. They could then force you to liquidate or get your equity out to repay your debts. Okay. So these protections are very reasonable, and considering that equity is what you've actually paid off on the remaining balance of your home. And most people only live in a home for around 5 to 7 years. So we did already discuss the $2,000 deduction that is going to be applied to your actual monthly property tax, and that's going to reduce your monthly costs. It's very, very beneficial, and you do need to apply almost immediately when you buy your home because it does not apply to your taxes until the following year. So keep that in mind. If you do not apply that, you may see a striking increase to your payments every month after purchasing a first-time home. So federal deductions that are included with you being a homeowner, they're very simple. Miss Aliyah mentioned if you have interest being paid, that's tax deductible. Very similar here, your mortgage interest rate, that is tax deductible, as well as your property taxes that you pay to Uncle Sam every year, that is a tax deductible item. Okay, so we're going to talk about some of those benefits that are more advantageous for our landlords. So we started this discussion out as investors. You will always be an investor. That doesn't mean you will always be a landlord. Landlords are the ones who take on the liability to host tenants, whether that's long-term or short-term. They can have a variety of tax write-offs that you may not have as a homeowner because they're taking on additional liabilities and expenses. These expenses can obviously include the mortgage interest, the property taxes, as well as their insurance. They're paying insurance to cover a tenant. They may have renter's insurance that they don't require the tenant to pay, they pay themselves, and that would be a taxable item. So depreciation. This can be written off based on how much your home has, I guess, really declined over the past few years. Obviously, weather happens. We had snowpocalypse round 2 this year, and those kind of things wear and tear on your brand new roof, on your heating systems that's not used to enduring 20-degree weather. These things start to break. You do need to do upkeep and maintenance. And if you do not do the upkeep and maintenance, it is considered depreciation. It's a decrease in the value of your equitable asset. So these can be used as a tax write-off or tax deduction based on what your tax professional does advise. Utilities, if you are paying them on behalf of the tenant, you can also deduct. But as Aliyah said, if you're getting a bill that you're not paying, you cannot deduct that. So if they are paying those utilities, do not provide that to your tax professional and do not expect that to reduce your taxable income. So we are here to talk about generating wealth, how people keep it, and minimizing capital gains tax is going to be a key component in doing that. Let's go back to our previous example. We've now been burring, we've refinanced multiple houses, we have a lot going on, and we just really want to know, should we sell one of those rental properties or should we sell the first house we started in? This is going to give you a great example. Capital gains is the increase in asset, a house, value over its original purchase price, and is considered to be realized when you sell it. If you were to decide to sell one of your rental properties, that is almost inevitably going to be capital gains. The catch-22 is if you sell your primary residence that has been under your homestead exemption or not, you've occupied it openly for 2 to 5 years, because most people are in homes 5 to 7 years, you will actually be able to exclude up to $250,000 of your capital gains. That's amazing. If you were to make $250,000 off of your home in 5 years and still be able to keep it without Uncle Sam touching a dollar, that would be an amazing feat. You should honestly brag about it every day. Most people never make that much on a house sale. Not to be bold, but since COVID happened and houses doubled, that was maybe one of the only situations where you were actually receiving $250,000 profit off of your primary residence. So this is a great protection. And furthermore, if you are married, you're protected up to $500,000. That's absolutely ludicrous that you can make $500,000 and not pay any taxes up front. I think that's super impressive if you got to a point where you're Bill Gates, or heck, I love Johnny Depp. He's not even that rich, right? Bill Gates is way richer. And you just decided that you wanted to sell your $1 million mansion. You may incur that you weren't covered for all $500,000 in profit. So the wealthy move at a totally different level where this could be a drop in the bucket. Now, say Johnny Depp profited $600,000, he would have to pay capital gains tax on the difference, which is $100,000. So 500,000, 600,000, 600,000 or minus 500,000 equals $100,000 capital gains tax that he would have to pay. Now, based on Miss Aliyah's bucket system, he'll be taxed at different intervals based on how much additional income he had for the year. But it would be in his best interest, based on our first scenario, to not sell his investment, but to sell his primary residence to decrease his capital gains tax and further his wealth generation. Now, you may be wondering, well, why would I ever sell any of my rental properties then? Well, you have other options. If you are solely wanting to sell an investment property, you would do a different option called a 1031 exchange. What is a 1031 exchange? It's a fancy way of saying I'm moving my money from one investment to another. These investments do have to be like kind and fashion, and that really means it does have to be a form of real estate. You can shift from residential to commercial. You can switch from a single family home, which would be a standard home, alone by itself. Picture a 3-bedroom, 2-bath, not attached to anything. And you can take that single family home and switch it to a whole apartment. Those are still very like kind. Additionally, they have to be with the same intention. It's not because I want to now live in one of the units in the apartment or I want to upgrade my single family home. No, the property has to be solely for the purpose of investment and cash flow opportunity. This is what the IRS is going to look for, as well as the IRS is going to make sure you did not do this on your own. You will need to hire a third-party company that services the 1031 exchange to a T. You have only 180 days to replace your previous investment and avoid paying your capital gains tax on the sale. So this is a very meticulous process. You do need to consult with a professional tax prepper as well as a 1031 exchange company to get this done right and properly efficient, as well as speak with a qualified real estate professional such as myself. So these are great ways to minimize your capital gains in that you can sell Johnny Depp's house that he rents out to Miss Aliyah when she's in California. And he decided, well, she pays me good, but I think I can make some more money if I decided to buy a hospital. Why not? Right? He thinks COVID was really just a boom on the economics. And he said, let me sell this $300,000 house I owe no mortgage on because Aliyah's paid it off over the last 30 years for me. Thank you. And I'm just super excited because I don't have to pay any taxes up front because I'm putting that money, that $300,000 deposit, on my $3 million hospital. So I now had a 10% deposit on a extremely expensive property that I never imagined that I could afford. I've generated wealth. I've not paid taxes on it in so long. It's just sitting there. I feel a hole burn into my pocket. I want to spend it. So I now go and I take this money. I own a hospital now. Now all of a sudden, my rent that was only $200 profit a month, I'm making $2,000 profit every month. And on top of that, my tax deductions, they've increased tremendously. Wow, we have utility bills out the wazoo. We are now doing donations and having child fairs, and everything is just coming together where I never pay taxes anymore. I make $2,000 a month and I never pay a dime on it. That's wealth building. That's 1031 exchange. And it may seem really extreme, but that's what people are doing every single day to generate wealth. And we fast forward another 7 years. Johnny calls me and he says, Connor, this hospital was a hit, but I'm sick of it. I can't deal with the sad people and all of this. I think I'm going to sell the hospital. And Johnny sells the hospital for $6 million. And he says, Connor, I think I'm going to 1031 exchange it again. Now he has $6 million untaxable income to use as another down payment on, let's be honest, probably an island that's now a resort that now cash flows him $10,000 a month. So I know these are all hypothetical and these are just examples, but these are real world things that are happening. So we're going to carry on. I hope this was educational. I really want you to have an understanding that homeownership is real. It doesn't take you having 20% down payment. It doesn't take you having a perfect credit score. And with that, we're going to get into our first-time home buyer programs. We have Georgia Dream. It's a program that targets first-time home buyers. Your maximum home sale price can only be up to $425,000, which I always say that's a good thing. Let's keep your monthly payments as low as possible. The way interest rates are looking these days, that could easily be $3,000 a month. And that's sitting around 6.5% interest, okay? That's even with your first-time home programs. That's with them reducing your interest rates because you're a first-time home buyer. And you have to keep in mind there's limits to your income to take advantage of this program. As a single person or even a household of two, you guys are maxed out at $120,000. So you're saying you make $120,000 a year. Let's do some math real quick. Divide that by 12, you're making about $10,000 a month, and then your mortgage payment would be around $3,000. So you're spending less than half of your income, but are you comfortable doing that? So keep that in mind as you go into this process as an investor, not as simply someone who's buying a home for their family to put a roof over their head. We don't want to end up underwater. We need to make sure that you're constantly in a position where you can afford the home, you can afford to be building your equity, you can afford repairs, and you're ready to be a homeowner. Now, with the Georgia Dream program, you don't need to have all the money in your bank account. I know it sounds crazy. I said it. You don't need a perfect credit score. You don't need 20% down. They have down payment assistance as low as 0% down. These offers, it's up to $10,000 towards your down payment. You do not need to pay it back unless you actually end up selling the home or you're not using it as your primary residency anymore. And then you kind of like just hang out in there. It's a really nice program. It's very limited in that it seems super simple, but the way that housing has become, 425,000 just doesn't go as far as it used to. These limits actually used to be lower. They were in the 300,000s. And now if you're looking in, say, Gwinnett County, $425,000 may get you a fixer-upper. And I'm just being realistic. It's a great program. We just have to meter our expectations. The government does not want people not in housing. They really want you to be able to take advantage of FHA loans, VA loans, USDA loans, and conventional loans. Now, what the point I'm saying here is they are offering this program with no restrictions on the loans. You could use any loan and still have access to this program as a first-time home buyer. You just have to fall into the categories of income as well as fit their categories of how much the house costs. If you happen to make too much money, you still qualify for what's called the Peach Plus program. This is going to allow you to make up to you're going to be able to afford a home up to $525,000 and make up to $180,000 as a household. Now, they say 3-person. That means if you have dependents, they do allow you guys to have an additional amount of income into the household, but that doesn't necessarily change your ability to purchase drastically. I mean, $18,000 isn't going to go that far, right? So realistically, these first-time home buyer programs are available to you, and you have to decide if you want to use them or if you're really wanting to pay down your equity sooner and not have as much liability overhead. So I'm going to give you a quick example. Say you take this $10,000 in down payment assistance. It is a second loan with no interest or monthly payments, and the economy totally tanks like 2008. You now have an additional $10,000 of liability on top of your mortgage that could put you underwater. That's just a realistic expectation. These home buyer programs are great opportunities, but you have to decide if you want to take advantage of no down payment or if you want to take the time to come up with your down payment. People can afford a house a lot sooner than they think. It's just how comfortable are you with your financial setup? So I want you guys to know this is not the only down payment assistance we have. We also have home stretch down payment assistance. This provides up to $10,000 in down payment assistance as a 5-year deferred payment loan. So after that 5 years, you guys are going to incur some sort of interest, and that's going to be an increased monthly payment. It's going to be something you would need to discuss with the lender, make sure you're comfortable with the adjustable interest. But again, it's essentially free money for 5 years. If you knew that it was going to take you 5 years to save up your down payment, well, you might as well purchase the home today and start generating wealth and equity, reducing your tax liability, and seize the opportunity before maybe equity just rises too rapidly again. So we're going to carry on to this next slide. How to choose a realtor. And this is very, very similar to Miss Aliyah's post on how to choose your tax pro. It's based on assessing their credentials. Now, that's very difficult with a lot of real estate agents because we have such variety in what we can sell. We have leasing agents, we have first-time home buyer agents, we have VA specialists, we have relocation specialists, we have commercial specialists, we have land acquisition commercial specialists, we have only residential commercial specialists, we have only hospitality specialists. People really don't realize that there are so many individual real estate agents that you need to narrow your search. A qualifiable realtor will tell you not to work with them. I will firsthand send you to somebody who more so fits what you need for your objectives, and they will likely still pay me. So there's no reason for me to stand in your way of success. A realtor will gladly send you to a more qualified agent to rapidly get you into a property and close the deal or help you acquire the investment strategy that you need. So do not ever feel obligated to work with a realtor because they're your family member or because they have accolades in a certain field. It doesn't necessarily qualify them to be your real estate professional. Okay, and for you to assess these credentials, simply talk with them. They're going to tell you what they've sold, what they're comfortable with. That confidence, it can't be eluded. You really know what they've sold and what they've done. You can check for your industry expertise. A lot of us do have websites. If you can't Google an agent by name and they come up instantly, that's our joke. Don't work with them. They should have a Google page. They should be findable on their brokerage website. They should have reviews. They should have sales history on Zillow. Like, it just comes up automatically. You don't really have to look that deeply for your agent to know if they're a good fit for you. Okay, now ask about your services offered as well. Not all agents are full service. That's really wild to think about, but there are actually limited service agents. There are part-time agents, there are full-time agents, there are agents that list and allow you to do all the work for yourself while you're selling the house because it's a reduced price. There's agents that you call and they just give you the code to go in your house. So ask about the services and meter your expectations. You get what you pay for. I'm going to keep it very, very simple. If you want a $500 realtor, they're out there. They'll teach you how to buy a house. Good luck. You're on your own after that. Or you can go and get a professional and they may charge you the full 3% commission. Heck, commissions are legally negotiable. I've seen people try to charge 10% and get it. So be very, very wise, understand their fees, understand what the services are being offered and why you're being charged for that. Because after that NAR lawsuit, that's the National Associations of Realtors, if you guys want to look this up, all commissions are negotiable. It doesn't matter if you're on the buyer side, the seller side, it doesn't matter. I can tell you what I want to be paid. You can disagree or you can agree. And once it's agreed upon, it's getting paid. So just remember, you can pay me $1, you can pay me $10,000. It's really between me and the client or you and your professional, okay? Verify your reputation in reviews. Like I said, you could plug my name into Google. You're going to find me. You're going to find Downey and Associates. You're going to find me connected to eXp Realty. You're going to find me on YouTube. You're going to find me on TikTok. You're going to find me on Facebook. It's just there because I put that effort in. I present myself. I mean, I have a realtor tag on my Forerunner. It's obvious, it's blatant. I am a social figure. I am a public figure. I have to maintain my ethics courses. It's legally required. If I'm not doing these things, they strip me of my license. So a lot of these times, it's very simple to verify their reputation. You really just have to look at number 6 at the end of the day. This one is so important for the real estate agents. Communication. Not to put anybody under the bus, but I worked with this agent recently. Great guy, terrible agent. He's been in business 20 years. This is an 80-year-old gentleman. He does not send his clients copies of their estimates. This is totally unprofessional in the sense that your job as an agent is to mitigate your client's time. If Aliyah is my client and she is actively working throughout the day, it is my responsibility to communicate with their tax prepper on their behalf. It's my responsibility to communicate with their attorney on their behalf. It is my responsibility to be available to you as my client when you're not available for yourself. I'm an agent of you. I am acting on your behalf. I am acting in your best interest. If you do not have communication or find that your agent is doing what you believe is ethical or morally obligated to you, fire them. It's that simple. There is a termination. You may owe them some fees, but if they have actually not done what you guys agreed upon, then you don't owe them anything. They did not complete their contract. You guys agreed to certain terms and certain expectations. And if they are not prioritizing what you need as a client, that violates their judiciary duties. So you guys really need to realize that if you're not hearing from a realtor within 4 hours, 5 hours, and they don't have an explanation, that's a concern. If you haven't heard back on your inspection reports, that's a concern. If you haven't heard back on the areas in which you've been looking for a home for 3 months, that's a concern. And even when it's simple communication and updates to say there is no update, that's a simple expectation of your agent. That's what they're getting paid the big bucks for. You should not be paying big bucks for someone to text you at the end of closing saying congratulations. So it's very simple. I mean, real estate is something that is going to be one of the most high stress experiences in your life, and make sure you have a partner with you that makes it a lot less stressful. That's the end of this. Again, as I mentioned to you guys, if you have questions about specifics on what documents you need, credit scores, Aliyah and I are happy to partner you up with our lending team on that aspect, and they'll be able to narrow down exactly what it is you need for your specific situation. We can get you in a house with bank statement loans. We can get you in a house with low credit. So we just need to do a personal consult, or we can go ahead and do a separate video where we cover those individual topics. But thank you so much, Aliyah. Does anybody have any questions for me?
No, don't look like any questions. But Connor, I do appreciate how thorough you have been in the whole real estate process. And I know me personally, you are definitely going to be my real estate person. When I'm ready to buy a home, I'm definitely coming to you.
Oh, thank you so much. I'm super excited for that. And again, everybody that I have tax questions, I always send them to you. I actually heard from Sean the other day. He's going to be in town on Sunday.
Nice. Okay.
He always rants and raves about you.
Okay, I appreciate
Always.
it. Yeah, Sean, that's my guy. I'm not gonna lie. Just like you're saying, a real estate agent is someone who's supposed to advocate and act in your best interest. I do the same for my clients. I will go to bat for my clients. And
Absolutely. And everybody that I've talked to that's worked with you loves you. So super excited. Thank you so much, Palumi, for coming. And I mean, if you have any questions, we're going to end up sending these videos out. We're going to end up having all the information for you to review at your own time. I know it was a lot. So please email me, get my contact from Aliyah. If you have any sort of concerns, it's always free for you to talk to me.
awesome. All right, Connor, you enjoy the rest of your day, okay? And
All
again,
right. And I will see you next month for this. Okay.
sounds good. Sounds good. And
All
thank you
right.
everyone for attending. We're gonna go ahead and end it here. Awesome.
Well, that was cool. That one was smooth.
Yeah, I think that one went a whole lot better.
Do you want to email it to me once it's like done and I can edit it up and we can get it on YouTube?
Heck yeah. Let me do
Okay.
that.
And then I'll send the link to you on YouTube. Do you have a YouTube yet?
No, I don't. I'm like, yeah, man. No.
It was a lot. I spent most of last year doing it. I posted 112 videos.
Oh, wow.
I have 800 subscribers and I got 0 closings from it.
Yeah. That's being self-employed, man.
Yeah. I mean,
Like,
the TikTok thing got me leads and keeps them coming, and they're actually closed. They've been more immediate, but I'm just trying to keep up with the YouTube because, like, for example, I had a video that had been posted for 6 months,
mhm.
and I checked like last month, and it randomly had 30,000 views.
Okay, yeah.
So I was like, yeah, that was that re-gratification. Like, I just need to have it up
Mhm.
because maybe fast forward 2 years from now, or when they drop the rates so hard that everybody's really searching for this
Yeah,
stuff again,
yeah,
then I will get my future money off of it.
yeah,
So
yeah.
just working on it.
Yeah,
So I think,
that's just working on it. It's a process, that's for sure. Um, I do want to get on YouTube. For me, it's just a matter of not being so much in the day-to-day of everything. So I've got me a little team going so that way I can focus on social media presence.
that's fair. And I like this. I like us just being able to use the recordings because then you just two bird, one stone because
Yep,
you're so busy.
yep. So let
So
me,
that's fair. This is, yeah, I mean, and I'll definitely post all your social media to the YouTube channel and stuff. So that'll be a good avenue
yeah.
at least.
Oh, no, that's not basic. Okay, so I'm waiting for it to process and then I'll send it over to you. But I definitely send your information out. You are in my workflow on my CRM website. You are in my workflow. Everybody gets access to the website once they're done with their taxes and things like that.
Oh,
Um,
perfect. Well, this was really great. I'll get that all settled up and edited for you.
okay,
And then, yeah.
good.
So just let me know the date for next month. And
Okay,
then I'll do I guess you already have the flyer, so we'll just change the day and I'll get them all posted up to the Eventbrite and Facebook.
perfect. Okay, sounds good. I'm going to, you okay with using this recording for the 3 o'clock recording?
Yeah, I liked this one.
Okay. All right, cool. Sounds good. That's what I'll do.
Oh, we're like right on time.
Yeah, we did good this time. I do agree. I tried to add in a couple jokes. I'm still working on what is this called? Public speaking.
I mean, you're very articulate still. You've always been.
Thank you. Yeah, I'm very technical. But once you get to know me, like I'm really goofy. So it's just a matter of being comfortable in front of a whole bunch of people.
Yeah. Well,
But all right, Connor,
how long have you had your septum?
my septum 5, 4, 6 years. It's been a while.
You're so cool.
Yeah, I don't always wear it though. I'm about to get a grill. That's my next.
Is it bad that I like maybe 2 years ago, I was like, man, I kind of want a grill too.
No, do it. I think it will match you, like your outfit now. If you just had like some grills in there, it would. Yeah,
Yeah. I
yeah.
had this other realtor I did a deal with, and he would just got out of the Marines, and that
Mhm.
was the first thing he did was get a grill. And he looked really nice. Like he was GQ suit up, but
Yep,
grill. He was
yep,
like, yep,
yep.
I'm out.
Look, that's the vision I have for myself. Like, I'm gonna get me a nice little. I'm gonna get a bottom grill, and then in the middle of it, I'm gonna have some words. It's gonna say boss, and I'm gonna be dressed to the T. Okay, yep, yep. Not gonna wear it all the time,
I
but
love it. You should let me take you out for lunch sometime soon.
yeah, I'm down for it. Just let me know when and
Yeah,
where.
we'll just coordinate the day we go and do the flyers. I'll take you out.
Okay, okay,
All
yeah,
right,
that works. That works perfect.
cool.
Sounds
All
good.
right, we'll
Appreciate you.
talk. We'll figure this all out. And thank you so much for the opportunity.
Sounds good. Same here. All right, talk to you later.
Bye.